All right. Well, welcome everybody. A big thank you to Przemek Gotfryd for talking with us all today. Przemek is a co-founder and COO at Capchase, a recently launched startup which provides non-dilutive financing for SaaS, software as a service companies. And before that, he was a strategy consultant with OC&C and a tech investor at Technology Crossover Ventures. Right now, he's enrolled in the MBA program at HBS, as a few of you may be too. And Przemek, I'll hand it off to you. Thank you so much for being here.
Thanks, Claire. Thanks so much, and again, congratulations on the fantastic event. And I know I used to run a couple things like this back in my undergrad days, and I know how much work it takes. So, big thank you and congrats. Yeah. So look, maybe and congratulations first of all to all of you for making it here. I mean, it's a great success. And it sounds like you're working on a lot of super exciting ideas and projects. So that's the first step, and it's awesome you guys are taking it so early. Look, I'd love to be as helpful as possible over the next 55 minutes or so. Maybe in a couple of minutes, I'll just give you an idea of what we're doing at Capchase, in case you might be interested in asking some questions around it. And then would actually love to take any questions you might have on any topics that are top of your mind, and I'm sure there are different things you're thinking about. So if that works for you, Claire, and the team, then maybe we could do that.
That sounds great.
Awesome, great. So so maybe to demystify a little bit what we're doing at Capchase. When you think about an average SaaS company, they probably would sign a contract with a customer for a product that they sell for the following 12 months. Let's say that somebody, their customer is paying $1,000 per month, so 12,000 over the course of the year. They don't see that cash until the following 12 months. But normally in their financial statements, they would book, we've sold something for $12,000. Now, at the same time, these companies need a lot of money to, for R&D, for sales and marketing, and so on. And normally they would go to VC investors. They would sell a part of their business in order to get that money to invest into growth. Now, what we enable them with our product at Capchase is extract all this cash flow from the contracts they already signed with customers, bring into the present day, get that cash upfront, reinvest it into growth, acquiring new customers, so that when they go to fundraise, they can do so with much more revenue, much higher valuation, and hence keeping a much greater part of the company that they founded and they're working hard to build. So effectively, it's an alternative to VC capital and venture debt. Maybe I'll stop there, and happy to answer any questions that you guys might have.
Maybe just one question on the model. So it sounds like Capchase has some sort of financing yourselves. Maybe you raise, maybe you get loans yourself from banks, and through let's say economies of scale, then you're able to offer loans through Capchase at a maybe lower rate than these other than you would be able to get otherwise as a startup. Just trying to think through the model.
Mm-hmm. Yeah, for sure. No, great question, and and I think that's why we also wrote a few Medium articles about it recently to help people understand what financing options are out there, how we compare, and why as a fast-growing SaaS company, it makes sense to use something that we're coming up with. So the most expensive sort of financing, also the most helpful that you might get is VC money, because you're effectively financing yourself at the cost of 100% of selling your equity, right? So that's kind of like, it's very useful, but it's very expensive. On the other hand, you have instruments like venture debt, where effectively you have banks where consumers that put in money for deposits. The cost is super low, so they're able to lend it to you at a relatively low cost. But it's not a scalable solution, and it doesn't grow with you as you sign on more and more new customers. So the way we work and the way we finance, yes, exactly, we go to institutions with low cost of financing, and then there is a little bit of a markup that we that we charge on top of that. And at the same time, the cost of what we're doing is way cheaper than selling equity to investors. So effectively, we're allowing you to recycle the cash that you already have signed up with the contracts that you have, unlock it, and to give you an example, at some customers that we've been signing up recently would receive, for example, a 10% discount on the value of the contract over the following 12 months. So if they're expecting to collect $10,000 over the next 12 months, we would probably give them like a $9,000 upfront.
So Przemek, can you tell us a little bit about what your motivation was when you decided to move from technology crossover ventures to founding your own startup at Capchase?
Sure. And I'd actually, when you guys ask the next questions, I'd love to hear about your own motivations. So we could maybe combine the two. It's super interesting to find out what drives people. Yeah. So look, first of all, my dad is an entrepreneur. So I've seen kind of what it takes to grow a business. I know it's tough. That's why I wanted to have a few years of experience, first as a consultant, and then as an investor myself to learn from other founders. And coming up to 3 years of a VC investing experience, I've realized that I've been sitting across the table from a lot of exciting and impressive founders that have had themselves amazing founding stories. But I felt like I've always been an advisor and maybe kind of like I was trying to help them grow that business. But the hardest part was always kind of actually being in the trenches and growing that business. And I felt that as soon as I find an idea that I'm somewhat passionate about or very passionate about, I would love to give it a go. And so I've actually met my co-founder Miguel, who I think has been holding some office hours with people in the previous 60 minutes at HBS. So we met in the second week of school last year, and then we've been sort of bouncing around different ideas. He was looking at various working capital solutions for different industries. And what we realized, he was coming from the background of being a SaaS operator. So someone who was working in a SaaS company and has been a head of sales and has seen the problems of trying to get the cash upfront from the customers to fund the growth. And I was coming from the background of being an investor and including looking and investing in SaaS companies. So I saw that, I saw a lot of entrepreneurs going and selling their equity to fund the growth while having all of these amazing cash flows, like really kind of tied up in contracts they have already signed, and they know that cash is coming, but they had no way to unlock it. So the motivation was really to kind of try and help like thousands of amazing founders around the world to keep more of their business and at the same time kind of grow their business efficiently.
Right, that makes perfect sense. Was there anything in particular that you noticed while you were at Technology Crossover Ventures that you really tried to address as an entrepreneur yourself when you were starting Capchase? Any problems that you kind of expected to face, eventually did face, but were able to tackle better because of your experience as an advisor on the other end?
That's an interesting question. I think these days people speak a lot about what they call founder market fit. For me, kind of personally, coming into a venture, especially because we are 4 co-founders, it was important that sort of everybody is really, really aligned behind what we're building and has some sort of personal experience with the problem. So that helps you in a few ways. One is, internally, you're just kind of motivated towards the same goal. Externally, it really makes it easier to explain both to customers, investors, and any other stakeholders why you're doing this, why you have the motivation to work on this particular problem and the solution. And it also, like, it just makes getting up every day and kind of working long hours a lot easier. So that was like a prerequisite for me. Secondly, so I was investing in companies which were at later stages, so kind of Series B, C, D, pre-IPO, the unit economics for these businesses that we would back were often, very good or excellent. So I really wanted to build a business from the very beginning that, you probably have read or learned about metrics like lifetime customer value, to CAC and so on. So all of these concepts, I wanted to be building a business where all of that holds from day one, and we know that we can build a sustainable company rather than a company with like an impressive initial growth trajectory because we're signing up a lot of names and then it kind of it might all crumble down. So it was very important to kind of build strong foundations on unit economics. And it was also important to me that I do it in a big market. That's why I was always kind of thinking about, what is the way to do it is there a way to do it in the US? Because whether you're building an enterprise solution, a consumer solution, kind of selling to a 350 million market, or a market which has, millions of companies is way easier than I feel building something in Europe, which has a comparable size, but it's fragmented across 20, 25 different countries. Just kind of a few observations I could go on, but building something solid, something that you can unite the team behind, and doing it in a big market where there's a lot of potential for growth was very important.
One question that I had, just thinking about at the early stages, I guess when you were raising your most recent round from investors, what do you think was like the top thing that whether an indicator of traction that you guys already had or like past team experience that was like maybe one of the main things that you think investors were betting on, because having some experience like building a company at the early stages, I can imagine like traction is pretty limited. So then there's probably like betting on mainly like future potential. So I'm curious with Capchase, what were some of those things that you think investors were hoping for in future rounds?
Mm-hmm. No, of course, and I think you've pointed at something important, which is the first money that you probably will be raising. I mean, most of the companies, because some become bootstrapped and so on, you're selling a dream, right? So how it's important to kind of like understand how you sell the dream, and also how you kind of like link the dream to kind of like partial reality with like some early indications of traction, as you said, and then you get partial credit for that early indication of traction, right, from investors. Mm-hmm. So I think for us, it was important that we are credible as a team. Therefore, I think being a group of 3 founders that worked at a SaaS company, one of whom used to run sales and face this problem of like trying to convince customers to pay upfront to get the money to grow the business. And on the other hand, kind of having an investor who like looked at a lot of these businesses was quite important. Now on traction, so we were raising with one sort of pilot that was about to start with a customer here in the Boston area, but at the same time we have probably done over 100 interviews with SaaS companies. And we were able to systematize the feedback that we received. And there was a lot of enthusiasm about what we were about to bring to market. And we were able also to point towards a broader pipeline that we had of customers who were saying, hey, as soon as you get funds that you can advance to us, we'd love to chat again. So we kind of summarized it for investors and showed them, hey, there is like 20 companies in those sectors which are that big, growing at that pace. And they sum up to that initial opportunity that made it. So
we could expect this sort of, let's say in 6 months, you could expect these customers to be on board.
Or at least we know which doors to knock at. And we have an early idea of what they call ICP, ideal customer profile. So it's important that I think everybody is at this early stage, sort of hoping that you diagnose the problem and identify a group of people that you can serve. That's the important thing. And I think it's important to show the investors that you're testing and iterating rapidly. So you put a hypothesis out there, you go and talk to 10, 20 people about it. Now, is it resonating? If not, like, what do I tweak so it resonates more? And hopefully by the time you're starting to maybe sign up first POCs, first pilots, that means that actually people are willing to like go with you. And if you sign paid pilots, that's even better, because that means that people are willing to pay for it. Now, I guess what I'm talking about is very much centered around the enterprise space and kind of like B2B. But I think, so there's a very kind of similar analogy going on.
Yeah, maybe for consumers, like identifying some core cohort that's signed up, like let's say 1,000 people, and they seem excited, so maybe it'll expand from the future.
Yeah, or a core demographic, or a core group of folks with, in that age or another bracket in that location that it resonates with.
Yeah, I guess I ask because I can only imagine at the early stages how little data investors and even companies themselves as founders would have to work on. And the valuations, even at the earliest stages, like let's say someone raises, I don't know, like $1 million just off of an idea, and it's valued at, let's say, $10 million. And revenue is like, I don't know, in the thousands of dollars, if any. It seems like a ridiculous jump to make. But I can imagine that if you're pitching the vision with some like initial pilots, maybe that would sort of justify it.
Mm-hmm.
So, yeah.
Yeah, and I think on that, very often folks would start by raising what they call a pre-seed round or an angel round, and people are asking, okay, how do you determine evaluation when it's so early? There's no revenue, like there's barely any product. But truth is, folks just have a valuation range in which they will like position you based on like how credible you sound as a team, and how big the market is, and whether you have prior founding experience or not, or they will look for a specific percentage of ownership, and then kind of based on the money that you raise, that sort of indicates what valuation they might be willing to put on the company. So it's much less scientific than it sounds like at this stage.
Yeah, that makes sense.
So I think like there are a few brackets of buckets of questions that like might be going on in your heads, like stuff around the product, stuff around the go-to-market, stuff around questions around who do I co-found it with, questions around how do I get my first hire. Happy to address anything that you guys want to talk about.
Thanks for joining us. I have a quick question. When you're talking about talking to hundreds of customers, sort of leading up to this process, curious if you have any particular strategies on outreach to get those conversations. I think it's like a little bit different in its positioning than just strictly like sales and trying to sell a product. But there's certain ways to give off that vibe of, hey, this is more of just a conversation around a problem we're trying to solve.
Mm-hmm.
And yeah, exactly. Just to add on, these are like business customers too. So I imagine like finding the person inside a business to talk to is not as harder than like calling up a college friend for a consumer product.
Yeah. And give me an idea, both of you, like what markets are you guys going after as a B2B, B2C?
Yeah, so I'm sort of going after marketplace, so B2B and B2C at the same time.
Okay.
Yeah, and then we mainly sell to like consumers, so this would be we're more B2C, so it wouldn't be like as directly applicable, but I still think it's very interesting.
Okay, interesting. Yeah, so look, I think I cannot emphasize how amazing it is to be a student when you're setting up a business, especially a student at Harvard or similar institution, because so many doors get open, especially when you're talking about sort of companies and potential B2B customers. Procurement might be a little different, but I think first off, like just leverage the network, and the network size might vary in each case, but we spoke to professors, we spoke to classmates, we spoke to people that we worked with in the past. Some people I was kind of like evaluating as an investor. Miguel had his network from the SaaS space, in Spain, in the UK, also here in the US. So we kind of like tapped into those resources, and we probably got the first 10, 20, 30, 40 conversations that way. and also then you get folks to refer to you. And I think the way you should be approaching it is exactly like you said, Jordan, which is, hey, I'm a student. I'm kind of like working on this project, like trying to address this particular issue. Would love 15 minutes of your time just to like kind of get your feedback. Always ask for 15 minutes or 20 minutes because it's really hard to say no to 15 minutes. And try and keep it to 15 minutes. And you'll be surprised how many folks are going to speak to you for 45 or 60. And you can extract a lot of learnings that way. Our first customer, our first pilot that became the first customer, actually came about through one of the HBS professors. So I would really tap into people you know, and I think kind of mine LinkedIn as much as you can, and the different kind of clubs and societies that you might be part of, and sort of go from there.
That's super helpful. Thank you. I'd be curious to hear also a bit more on the hiring process. I think, as lots of people say, you know, like your startup is the people that you have on your team. So I'm curious, as you start to scale, where you look to, I guess, right away initially, and then as you start to think about scaling. I know you guys have closed a big round recently as well.
Mm-hmm. Yeah, no, it's always really the, you know, alongside getting customers is the number one priority always, right? Because people and talent is what makes the company. So I think early on, before you have any sort of brand, so before you know, I don't know, get a TechCrunch article, whether it's justified or not, or, you know, people recognize you for one reason or another, you probably should just start with your own circle of friends and acquaintances, and just ask around. And you're probably all tapping into, you know, some groups of friends which might be connected to developers at some point if you're talking about technical talent. So the first, outside of the 4 co-founders, the first person that we hired as a senior engineer actually came through a recommendation of somebody that one of my co-founders knew from their old company, and you know, and we ended up hiring in another country because that person came from the Czech Republic. So it is all very global right now. I think first off, I would really sort of rely on people you trust to kind of refer relevant roles rather than posting anything on LinkedIn or kind of getting relatively random inbounds. And then, you know, every person that you add to the team probably knows another group of people. So really, we probably by now ended up hiring full-time another 6-7 people through the network and the connections. And I think clearly when you're probably at about, I don't know, 30, 40, 50 people, that's when you kind of like start to advertise in a more commercial way. But before that, you know, kind of advertising in the broader network is actually bringing pretty good results. And I think when you're also thinking about tech talent, obviously, I don't know if any of you have connections to other parts of the world and so on, but, you know, hiring in San Francisco or even Boston is extremely expensive, especially on the tech side. If you can tap into networks and have connections, you know, in other parts of the world where you might be able to hire for 30 or 50% of the same cost, it probably might be worth it.
Yeah, just on the hiring from other geographies, I've had I know of some companies in the fintech space. One of which I worked with that had a lot of connections in India, and apparently engineering talent there is strong. And I don't know how much wages are discounted, but it seems like it was a much more affordable option with the founders' connections. So yeah. Mm-hmm. And maybe on that note as well, just on I guess Capchase in particular, at least with that company, which did sort of credit card financing, I know they had a lot of instances of like fraud was pretty high, even for even detecting fraud among people with like existing credit histories and like purchase information. That was already difficult. I can imagine with early stage. I guess like maybe 1 million ARR companies, they have some traction, but maybe the contracts are more up in the air. So maybe it'd be like harder for Capchase to detect. I don't know if you have any approaches that are different than normal like individual credit financing that would make it easy, more intelligent, maybe data driven to detect whether or not like X company in a certain market would be able to like pay back their like $100,000 like receivable.
That's a good question. And look, the risk analysis, risk management, and scaling that function is really what makes or breaks the business. So we pay a lot of attention to it. I think, you know, the important thing is we live in a data-driven world, and the important thing is to rely on actual data that ideally cannot be faked in any way. So the way you get that data is these days with services like Plaid for banking data, obviously Stripe or Recoli for subscription management data, because those services actually show you transactions which actually happened that you can verify. So then you can ascertain that there is a certain monetary value connected to these transactions. And also you can reconcile that then with whatever figures you know, entrepreneurs and the companies give you in the, you know, profit and loss statement or cash flow statement. So we always we have a strict rule of always going down and kind of confirming you know, whatever aggregate data we get with the actual underlying data, and you know, depending on the size of the company and the market and whether they have a CFO or not, it looks more or less orderly or a little bit more messy. But we actually, you know, one of the things that we're actively trying to help our customers with is actually putting their accounts and the data in a way that makes it easy for us to advance them funds based on our underwriting. Because you know, if everything looks great, then it takes us very little time to analyze a company. Hence, we can offer them potentially a higher advance and at a lower cost. So they incentivize to provide you know, information which is easily digestible as well. I just got an idea. I think we have about half an hour left. Would it be helpful that we just actually there aren't that many of us. Would it be helpful that we just go around the room and maybe I think Jordan and Brian, you kind of touched upon what you guys are working on. I would love to hear about, you know, the other ideas and maybe if everybody could mention what's top of mind for them, we could just delve into that little topic for a couple of minutes, if that's helpful. I'm totally flexible. Just an idea.
That sounds like a great idea. I don't know what you think, Claire.
Just kind of really quick, and I think Marwan has a question. He's been raising his hand for a bit.
Perfect.
Something on LinkedIn.
Yeah.
Okay, perfect.
So
you can introduce yourself too, Marwan. That.
this like chart like coincidentally kind of came up in my feed here.
Great.
And I kind of want to. This is really cool, by the way. It was really eye-catching. So I kind of want to understand more about like what this red area is and what causes that. And also, is there any reason why VCs haven't looked at the model of doing their traditional VC financing and partner with you guys as like a sort of like cash flow hack plus that VC funding and see if that has any like interesting compounding effect?
Yeah, no, it's a great prompt because in fact, you know, in one of the recent articles we wrote in Medium, we talk about entrepreneurs perhaps taking into account when they raise equity, kind of complementing it with an instrument like Capchase. So I think the gap that you're seeing here is sort of representative of the fact that as a SaaS company, you have to front invest a lot in R&D and sales and marketing. Then you sign up a customer. So at point zero, you can already tell the VC, hey, I've just signed up a customer which is going to pay me $1 million over the next 12 months. And it may be paid quarterly. So over the 3 months, you're not seeing any cash flows unless you're charging some implementation fees. And so you're sort of like, if you do it like 10 times, there's a lot of effort to go on sale to develop the product, but you only see the cash maybe, you know, 3-6 months down the line for the first time, and then it starts to trickle in. So what we're saying with Capchase is, hey, the moment you close a deal, we can give you that cash flow that you're expecting over the next 12 months. so you can go ahead and kind of reinvest it into acquiring the next customer. And that's kind of how you plug that gap. Because I think the VC funding line here, what it represents is that until you acquire, maybe for like a bigger raise, quite a few customers, the VCs are relatively reluctant to give you a bigger amount of money, which can sustain you for long enough. So it's only after you've kind of proven and invested a lot of money into acquiring a bunch of customers that they kind of like start believing in it big time. And in the meantime, you have this kind of cash gap that you need to plug one way or another. So what we're going out there and saying is, hey, if you're thinking about raising $10 million in a Series A, well, we know that over the next 12 months from all of your customers, you're going to be receiving, another $10 million. So how about, we take 50% of that, we accelerate it for you. So we give you $5 million today from the contract which you've signed, and you only need to go out there and raise $5 million. And that leaves a bunch of ownership in the company in your pocket.
And so what do you do in situations where you don't, like, how much, let's say, the like monthly recurring revenue is per user or per like account, but you don't necessarily know how long they're going to be subscribed? How do you find out what the lifetime value is without knowing that?
Yeah, that's a great question as well. And the way we deal with it is the following. We absorb data from Stripe and similar platforms. We run historical analysis so we know what the retention metrics are on the existing customers for a company that's been around. Then we know that we can tell that in a year, probably 80% of the customers that we see today will still be with that business. And whenever a customer that we sort of finance for that SaaS company churns, so goes away, we substitute another contract in its place. And because they are growing businesses, they're adding a lot of new customers every month. So there's always another contract that's available to replace the one that's churned. So whenever we go out there and finance a SaaS company, we'll probably scale up to quite a large extent, and much more than a venture that would. But we would leave a good cushion of contracts that we don't finance that we can substitute in case some of them fall away.
That's awesome.
Thanks, Marwan. What are you working on? Love to hear a little bit, and any questions about your business.
So we're working on like a modular banking platform, and basically how it works is someone is guided through an onboarding process with a financial advisor, and in real time, we're sort of configuring a banking app that's tailor-built to your needs. And then our model is fees for people building out these mini apps onto that centralized platform. So let's say a bank is, or like a financial service provider is selling, a lending product through us, or getting the customers through us, then they would be paying a fee to sort of list that product on the platform, and then also some form of like capital intro fee. Obviously that would like vary a little bit based on what the type of financial service is, but it's not a direct subscription model per se, but it has like similar sort of monthly recurring revenue to it.
Got it. Very interesting. So you're building an equivalent, let's say for the online merchants, Shopify would have a platform where they would host a number of different apps that would be, could be used for different verticals and so on, and you're kind of like building something similar. Exactly. Very cool. And what sort of like, what are you guys running into as like kind of issues you're trying to figure out? Like what's top of mind?
So our biggest foreseeable issue is basically like, how do we get some form of early revenue before we actually have these apps listed on our like app exchange or something like that. So basically we're going to have a user base of people that need banking services that ideally we want to provide as cheaply as possible for the end user. But until we have like a critical mass of being able to have people on the app exchange and different products being sold in that way, we kind of need like an intermediary model that keeps things sustainable. And the hard part is we're trying to find a way to do that doesn't involve directly making the end user pay.
Got it. So you don't want that would be like for example, customer service person at the bank. That would be the end user that you're talking about. So you don't want them to be paying.
So the end user is actually just like high earning, not rich yet individuals. So regular.
Oh, I see.
It's like a direct to consumer product, and then our anticipated model is like market making, rebates. So sort of, let's use Robinhood as an example here. If they're offering securities with zero commission, they need to have a model where it's like based on those rebates and lending products that they're selling and stuff like that. But until they have those products available and have those relationships made, there's no model there. Our concern is that if we don't have that, we'll be raising money in a very, like, I guess for lack of a better word, like exploitative way.
Awesome. Got it. Yeah. So no, it's obviously a $1 billion question, right? That's why you're working on it, I guess. It sounds like there is. So first, Robinhood is making a lot of money by selling trading data to hedge funds and similar institutions. That's how they kind of subsidize your zero trading fees, and then they kind of stimulate more activity. I think that's kind of public. So it's a very clever way. A lot of questions around it, but it helps. I suspect, and I'm not sure whether you've been thinking about sort of, since your end kind of user is a consumer, and there's a lot of kind of need for financial education and kind of like content around all sorts of issues that they probably like trying to solve for, sort of creating a platform geared towards that. So creating something that you can position out there as a kind of trustworthy source of information that they're looking for. And then, over time, as you kind of like build the audience and you become a bit of a brand in the space, you might be able to start introducing some third-party providers and kind of integrating them that way. And it is tough. Kind of getting any brand off the ground is pretty tough, but there are ways to kind of hack community building. For example, you can buy Instagram communities. I mean, I'm not saying Instagram is the best platform to look for your end users, but there are ways to do it. So no, very, very, very interesting.
Yeah, that's great advice. I'm definitely gonna look more into that like intermediary data play. That's a cool
data play, eyeballs, and I think B2B players follow the eyeballs end of the day because there's a lot of potential customers there, right? So I think it's the kind of sounds like it is as you said, a marketplace. So there's always an issue of supply versus demand. Very often it is about the supply and then the demand follows. In this case, looks like you need to create the demand first, which then becomes valuable for the business players. So
exactly.
Fascinating.
Awesome, man. Thank you.
Sure.
We need to go around the room and describe something that we're working on. So
sure. At HBS, they cold call people. I could do that as well. Cold call people.
Yeah, we could go HBS style.
Maybe we don't have to.
I'll save the other people the cold calling until after this.
Okay.
Yeah, at least what I'm working on with a few other team members is an online events platform. Mm-hmm. Given COVID, online events is very prominent. There's some downsides with hosting events on Zoom. Like lack of interactivity. So we're trying to sort of redesign the experience, particularly for like business events and networking to allow for more spontaneous gatherings. So just targeting that specific niche. I think one of the hardest things that we've realized is doing go-to-market and actually getting any customers on the platform has been difficult. I think beyond like our immediate Harvard networks and university networks, finding the customers that you haven't ever met before, I realize that's like a whole different ballgame. We're just experienced in like building the software, but in actually going through the go-to-market strategy, like getting business schools on the platform, convincing like educators to put classrooms on the platform. Never really had the experience of like actually reaching out to the customers and then like almost like marketing. So that's been an interesting experience.
Mm-hmm.
So yeah, our primary users have been largely business schools. We have like Harvard Business School, some other business schools as well. And our approach has been pretty rudimentary. Just reach out to a lot of events coordinators and get a handful of people on. If people go to events and then hear about it and then think that it's good word of mouth, then they get on too. But anything more robust than that has been, haven't really thought of like a new strategy beyond that. So it's been going well for the scale of our project now, but that was something that we didn't expect initially.
Interesting. Super interesting. I mean, are you at HBS now?
A senior at the college, so not too far away. College? So fortunately, I knew some of the event coordinators. So
okay.
iLab was helpful among some other people.
Got it. Perfect. Are you familiar with Goldcast by any chance?
No, I'm not.
Oh, interesting, because it is a relatively similar platform that a few folks at HBS are getting off the ground, Goldcast, and they've raised some VC funding recently.
Yeah, actually, I think a few months ago I heard that someone at HBS was making something. Apparently, did you say it was called Goldcast?
Goldcast, like gold, Goldcast. So
okay,
I would encourage you to take a look, and that's right, yeah. And we can happy to connect offline, and you know, if helpful, good chat.
Got it. Okay, yeah. I mean, I think for HBS something like that would be, it would make a lot of sense. So
yeah. So I can kind of offer one kind of point of evidence, I guess, and I think it's probably what they did there, which is, and it was a very interesting way of hacking through a couple events that they hosted online, which is just inviting a lot of friends and kind of people they knew to an event that they threw. And that's how you kind of get to test some of the functionality of the platform. So I think, because it's an interesting chicken and egg problem, you need to have an MVP that you can test, that you can sort of show to organizations and business people, and the standards are pretty high, right? Because you know that a lot of folks have been switching from Google Meet to Zoom to another platform based on whether they've had a disappointing experience or not while hosting an event. So the stakes are pretty high. So kind of finding ways to de-risk, you know, that demo and kind of a pilot is pretty critical here.
Yeah. I think with the, definitely our experience building the MVP, certainly necessary. Many of these platforms you can't explain to people, like, you will have this experience, like the platform will look like this. It's very much an experiential one. So for those sorts of things, makes sense to make the MVP. So I think that was good in our experience as well. I like what Goldcast is doing in having a like targeted niche. Looks like they're very interestingly targeting these event marketers, which I actually hadn't heard of before. But I know these platforms. There are many of them, and it's important to have sort of a target niche. So it looks like they have a core demographic that they're going after. Which is good.
And look, the other question I would have is HBS or another Harvard school or another Ivy League school the right buyer? Because that sounds to me like a pretty demanding customer to start with. Like, could you go out there and just offer to host some much lower risk events for institutions where the bar might be lower? So obviously you want to have marquee pilot customers, but like there is a trade-off. And I think they might be more demanding versus just kind of iterating on something with less demanding customers.
Yeah, I totally agree. Our experience when we started in March and April, we basically started with sort of like Harvard like courses, mainly our friends. So it was pretty low risk, and they gave some great feedback. And then we gradually ramped up the kind of event. So we hosted some like informal social gatherings. And then eventually we had someone from HBS reach out for one of their conferences. They were very flexible with the issues in the platform, but I think we did try to do the incremental iteration, but I think even going forward, that's really important. Yeah, so I think that makes sense. Just sort of
Awesome.
iterate a lot, and then try to build off of the feedback.
Perfect.
Do any
Maybe
of
on the note of any iteration, have you guys been doing? What does it look like at Capchase right now? Are you would you say you have like a standard like business model that you're pursuing for, let's say, the next X number of months, or and then see if that works? Like, what is the rate of like piloting and iteration for you guys right now?
Sure. Yes, no, we're actively in the market, selling a product. We've advanced millions of dollars by now,
Oh,
to
that's
dozens of
tremendous.
companies, which is great. And I think we've seen that need when we've had those hundreds of interviews sort of emerge quite rapidly. I think any company, and it doesn't matter whether it's an early stage startup or Walmart, is iterating on the product, right? So the pace is just much greater in a startup. So I think what we're doing right now is we're trying to make the product as convenient as possible, in terms of onboarding a potential customer in order to underwrite them, in order to shorten the underwriting time, and then in order to sort of service the advance, which is the repayments that we get every month from these contracts. That's an important part of the product development. Automating a lot of these processes, so kind of moving from manual to automation. We've been making great strides there. So that's where we focus as well. And then I think there's a lot of ideas that we have around serving different segments of the customer landscape. So there is an iteration as to what the solution looks like, and the size of the advance and the structure, depending on what type of company we're talking to, because we're finding some tremendous opportunity among the SaaS companies which have under $1 million in revenue. And then we're also seeing a lot of very interesting companies with a very similar problem when they have 20, 30, 50 million of ARR. And that, the need is somewhat similar or quite similar, but the way you design the product is pretty different, and the way you kind of go after that segment and market it. So we certainly have a very strong link between the customer-facing function, and we've just onboarded the head of sales, and in fact, kind of getting a lot of feedback from our customers in every conversation, and then we kind of translate that, real time to what the product and tech team is working on, right? So I think building any solution, you need to have
Super tight
solution, super tight connection between the two. So.
Yeah, definitely the interfacing between developers and then customers, that makes a lot of sense.
Does anybody have some last questions before we wrap up?
I'm curious to hear a little bit more on pitfalls to try and avoid when raising money, especially talking to different investors.
Okay. Yeah, well, why didn't I turn it into... Okay, I'll try and answer the pitfall kind of side, and there's I think things to do, maybe at least that worked for us. So I think some people say that, and I believe that it's easier to sell the dream than sell the metrics. So for the first round of money that we're raising, first of all, ask yourself the question, do you need to raise it, and what for, and have a very clear idea what you spend it on. And if you need to raise it, it's actually good to raise the pre-seed or angel money when you just have an idea and a piece of paper and a very basic MVP, because the funnel of outcomes is still very wide, and everybody knows that it's wide, right? So then you're really kind of pitching about why you're passionate about it and why is it a big problem, and so that's part one. I think another thing I would encourage you to do is really iterate on the pitch. So start with low risk, even kind of start with pitching your friends who can, everybody's super smart here. you can all point each other out on like some weak links in the story. And just kind of like getting up to scratch is important. And then kind of start talking to funds or investors who may be less interested in. And you get a lot of very valuable feedback. And so allow yourself some kind of buffer time before you get in front of the people that you want to be raising from. And then I think something that I've personally observed is really like there are people who you want on board because of the expertise and just the kind of reputation and because they're great. But there's also the people you want on board because you like them and you get along with them, right? I think it's important to sort of balance the two, and I think that's why we're super grateful to have an amazing kind of group of investors around us. So the folks that we raised from, the lead checks from Bling, from Sci-Fi and Caffeinated Capital, we get along with everybody very well, together with a few other funds. And then I think when you're raising, a somewhat substantial amount of money for a pre-seed, just expect that people will be asking you to potentially leave school. That's another thing that you might have to be ready for. And I think the other consideration I would also maybe think through is there is a certain amount of money that starts exciting specific people. So some people are looking to invest between $500,000 and $1 million as a pre-seed. If it is a good fund, they will just have a requirement to do that. So that means you'll need to be probably raising $1.5 million to $2 million. Or some people will have a requirement of owning 10% of your company. So I think it's important to do that math beforehand and like kind of knowing your audience. And then maybe on like the kind of process itself, once you're like in front of an investor, it is, I think most, if not all investors are trying to sort of back folks who are very confident and very passionate about what they do, are not arrogant about it, and are very open to feedback. And we've had a few stories where we were asked to iterate on something within a matter of hours and then come back and talk through it again. And I think, partly, that could be seen as kind of like testing the team, because they only have so much time to do due diligence on any given team. So they'll be kind of coming up with potentially some exercises, and it's important to recognize when that happens, but also just to be yourself, because they want to kind of get to know the real founder behind the idea. So
I'm curious too, sort of just a follow-up. What do you feel on, especially early stages, having, for example, one firm close your round versus having a bunch of small checks in the door?
Yeah, like it depends like what you're optimizing for. For us, like to give you an example, it was important to have investors which are very strong at investing in great SaaS companies. So that is the role that Bling Capital, Caffeinated Capital, for example, Box Group play. Because it was important for us to get a lot of feedback from the portfolio to kind of optimize the product. And then it was important for us to have a fintech investor where Sci-Fi are very strong, for example. So that meant that we would go out there and try and raise from a few funds. So I think in every company you will be trying to fill a few gaps with expertise, and it might be product, it might be go-to-market, it might be recruiting, it might be, I don't know, compliance and regulation when you're building something relatively complex in the banking space. So I would optimize for anybody could give you money, and a lot of you are gonna raise a lot of money, but kind of optimizing for the right smarts is important. And sometimes you might have to split it up between a few funds. Having said that, you need to give enough to the main funds that they are actually interested and bought in, because they might have a required ownership percentage or whatever it is that they're shooting for. So it's important to know that up front. And finally, maybe actually that's related to the previous question, which is what not to do, what to do at the end of a meeting, always ask about the process, because that will allow you to then track how well you're advancing against that process and whether you're falling behind, whether they're getting excited or not. So it's like, okay, tell me what happens on Tuesday. Tell me what happens on next Monday. Tell me what happens in 2 weeks. Allows you to kind of benchmark your fundraising process.
Super helpful. Thank you.
Of course.
All right, any more last questions? All right, thank you so much for your time, Przemek. We really appreciate it.
No, thanks, Claire, and thank you everybody. First of all for taking the time, and again, it's amazing that you took part in the competition, and sounds like you're working on a amazing kind of set of ideas. Look, Claire, feel free to share my email with anybody who wants to reach out. Happy to chat separately if there is anything you want to double click on. I mean, we're super early and we don't know a lot, so whatever I said today is like purely my 2 cents, and if it's, use it at your own peril. So
Got it. I can just drop your email in the chat really quick.
yeah, of course, exactly. Perfect. Yeah, and look, good luck, everybody. It's awesome, and thanks so much. It's been a pleasure to spend an hour with you.
Thanks so much.
Really appreciate it.
Have a good evening. Thank you. Bye-bye.